See my screen, can you just put a 1 in the chat box? If you can see my screen, can you just put a 1 on the chat box? Okay, 1, 1, 1. All right, so let's go. All right, so first of all, I usually start with the basic concept of how smart money works, and I usually start with this. So in all my tutorial videos, I always start with this. So first thing you have to do if you want to trade smart money, you have to understand levels in the market. You have to know the points where smart money will come in to hit your stop loss. So those are the first things you have to know. But basically, the common one you all know about smart money is when they come and take out equal highs, something like this. Smart money, you move like this, move market down, move it up, move it down, move it up the third time, then probably take out everybody here, then give everybody impression that it's break and retest, gives you a little profit, then comes here again. All right, then move up, take out your stop losses, then give you an indication that it's like break and retest, give you small profits, take it back in. So things like this is what you watch out for if you want to trade smart money. But remember that smart money trades don't come all the time. So you might just wait for a particular setup for a whole week and you might not see any trade. So as a smart money trader, remember that you have to be, number one, you have to be patient to wait for your setups. The maximum number of pairs I trade every week is just 2, most times 1. Maybe in a week I don't even trade anything. But remember something, once smart money picks any trade, you know you are definitely going to get a lot of profit. So that's it. So right now I'm going to start with this. All right, so okay, now the market moves like this. Understand structure in the markets. The market moves in this manner. First things first, the market moves in this manner. We have levels in the market right here. Okay, right here, we have levels like this in the market, like this. All right, so the market will move impulsively, kind of like this, come down, breaks this level. Now, it doesn't come down again. It goes up. It comes down here. It goes up. It comes down here. It goes up. Comes down here. All right, so understand what smart money is doing now. They are creating virtual levels for you to see. They want to trap you. All right, so now this was the previous structure that was broken. Now look at where they start forming the new support. All right, so something like this, they do it a lot. So when they do something like this, remember, if you know the structure of the market, you know how the market is moving. If it breaks the previous resistance, it has to come and test it as support. That is how the market should move. It's an algorithm that is programmed to move that way. But at some point, it's being manipulated because everybody cannot be on one side of the trade. So they create these virtual levels. Remember, this level has to be tested then immediately. So if they test it immediately, definitely everybody will start buying. So they create these virtual levels here, right here, go up, come down, and all that. Then start making this point to look like a new support level. Now, people will start buying off this position. Now, forgetting that underneath here is just what? An imbalance. Most times you see my chart, I will just come here and put something like imbalance. So right at those points, that is where you see when the smart money will just come and fill that place, then move the market. So something like this, you just have to, I think someone is on. Sorry for that. Thought I meet everybody on. entry. All right. So as I was saying, stops like this, always observe the levels in the market. If the market is just giving you that double bottom, triple bottoms, and all that, just look to your left, go to the left. What was the previous resistance? Is it in line with that support? If it's not in line with that support, mark that area and put underneath it imbalance. That is where smart money will come and take your money. Each time, they do it all the time. So now they create these levels for you to see here as your support. Meanwhile, this was the previous resistance here. This point here, right here. This was your previous resistance, right here. Now, they wouldn't just come here to test that. So they will come and give you that support level here. Give you that support level here. This is where you'll be buying from. All right. So then the next thing they are gonna do is they will just come here, right here, push this market down here now. Take you out, probably give you this this impression that this market is coming to do a break and retest here. Then either come down a bit, give you a double bottom. Most times double bottoms are valid when smart money comes in. That is the only time double bottom is valid for me. I'm going to show you on the chart once we get to the chart. Now, they will now start pushing the market up right from here. Now, they've taken all your stop losses right here because you didn't observe this previous level of structure. So this is just basically how smart money works. And this is how I trade. I wait for those levels to be obvious enough so that everybody can see it. That's why it takes time. You might just stay for a whole week and you might not see any trade setup. But you have to understand how the market is moving to know where the trap is, first of all. Understanding this level is key. All right, we are going to go to the charts now, and I'm going to show you right on the charts how smart money works. All right, so before that, let me just give you a daily analysis on GBP NZD. I think that I did that analysis last week, Wednesday, on the daily time frame, and I saw something. All right, so let's go to the daily time frame right here now. All right, now see something right here. Okay, a typical example of what I just said. Now see how the previous level was, right? This is on the daily. Now watch out. Remember when the fundamental pushed GBP. Now we broke a level of structure here. Now, are you seeing this level here? Right, this was our previous resistance that was broken right here. Now what happened? The market moved impulsively to the top side on the daily. Just, all right, moved to the daily. Now, what did it do? It came back here. Are you seeing what the market is doing? Are you seeing this level? Are you seeing this level? Right, now the market didn't test here. Now imagine what they were doing here all this time. They were just creating these virtual levels for you to see. These virtual levels, creating these virtual levels. Now, this is exactly what they do. Are you seeing these levels here? If you're following what I'm saying, can you just put a 1 on the chat box, please? If you're following what I'm saying, can you just put a 1 on the chat box? If you're following what I'm saying, can you just put a 1 on the chat box? All right. Okay. So let's move. So see something like this? Now see, they've created this level, this virtual level here. They come here, support, came here. You are seeing these rejections and all that. So people are actually buying off this place. Then what happened? One candle just comes, goes down, right? Feels the imbalance. Previous level, structure that was broken, resistance. Now they tested it, they push it back up. So this is where smart money, this is where we snipe from. Most times we snipe from imbalance. We mustn't see any candle there. Most times the market can just come and feel an imbalance, and immediately it feels that imbalance, it reverses. So imagine people that started buying here. You know how many pips up to this point? Are you seeing? This is about 130 something pips against you, and you will say, this market is actually going for a sell now because it has actually broken the previous level, like it has broken the support. Now the market is going down. Then what happened? The market just came down, started going up again. So all these levels are what smart money will just create and make you think that you have new levels of support. Meanwhile, it's just a trap. So this is just a perfect example of how they move the market. All right. So let me go to another chart now. I'm going to be analyzing one chart just for the purpose of this training. I don't have to go through too many charts so you don't get confused. All right. So this was the trade I called today, and I want to tell you what I actually saw before I, picked that trade. I'm still going to cover Fibonacci 78.6, maybe at the end of the session, like 5 minutes before the call will end. I will just cover Fibonacci 78.6. All right. So right here, I saw how the market was just moving right here. Although we have levels that the market will still need to come back to, levels like this. Like someone is asking a question. All right. Okay. Now levels like this, we have some interesting candles here. We have equal highs here, right here. So these are equal highs the market is creating. So definitely we'll still come back to those points. And then okay, so I think my chart is frozen or something. All right. Okay, now look at what I saw. First, we have one here. We have the double bottom. Then the market, went up into this particular range here, then broke out again impulsively. Then when the market opened with the gap, this gap that is right here. Let me go to the 1 hour time frame. This is why I actually called this trade, because I saw that this gap, there was a gap here. Look at, this was on Friday 6, then the market opened 8. There was a gap. Normally, if the market doesn't fill this gap immediately, what will happen is that it's going to trap a lot of sellers, then either make them, close their trade because the trade is already going against them. But their target is actually this gap here. But they won't just start pushing this market down because everybody will start selling, because they know that is what everybody will do. Once the market opens, everybody will start, let's sell to fill the gap, let's sell to fill the gap. Now, as that was happening, I was just, doing my analysis. I was checking on the 4 hour time frame. I wanted to see two things. On the 4 hour time frame, I wanted to see some kind of candles that went in the opposite direction, closed above, then went back in again. So I spotted this particular pattern here. This is just the usual, head and shoulder pattern. This is the left shoulder. This is the head. Then the market moved down. I have a gap here. This is my interest point. Then when the market opened, I saw this candle going up. I was like, definitely this market is going to create the right shoulder right here. So now switching to the 1 hour time frame, I need to see something too. I need to see something. These are confirmations I need to see before I take a trade. Now I have a candle here. I have an institutional candle here, kind of like, you see, market broke out of this range here. M formation, double top, came down, broke out of this particular range, this little range here, right here, broke out of this range, gave me that institutional candle, then dropped down. So this was my entry point, right? I put my entry point right here. But you know how the market does now. Most times the market might not give you this this accurate entry. Although the market gave this entry and gave us about close to 10 pips profit before it went back in again and came to this particular level to give us that double top. So this is also called the teacup strategy. When you see the market move in this direction, just expect the market to reject. This is a teacup strategy. Something like this, the market moves down, then we have something like this. The market moves down like this, moves down, then suddenly it comes up again. If you have a sell candle, like if you have a buy candle positioned here before that big sell, just put your sell limit just on that candle, on that buy candle, then put your stop loss just right above it. The market will just come and reject. That is how the market moves. Believe me, it happens. I'm going to show you other charts where it happens. So they mitigated off this position. If you go to the lower time frame, you can see that right at this point, the market mitigated. It came down, then it came and formed that tick up, double top before we had this drop. Now, that was the second confirmation. Now, the third confirmation I had was I had to use my Fibonacci. I placed my Fibonacci from the high of this move right here to the low of this move, just close to the gap. And right at that point, 78.6 was just in line with my candle. So this is like, how many confirmations now? 3 confirmations in my trading star. So this is 3 confirmations telling me that this market is actually going to go down from this point. So I entered off here. I put my stop loss right at 62,400, right at this point where this red line is. You can see how the market just came. I know at this point, some people were already getting scared because I know when this candle just went up like this, people were like, this market don't hit our stop loss today. But you see how the market just rejected at that point. Then the next thing, market started dropping. We still have this gap to be filled. Remember, the market will just give you a little retracement to the top side. Most times it can even come back here to give you a double top. I can't tell you how the market moves, but one thing I can tell you is that when I see my setup, I know the market will always give me profits. If it hits my stop loss, no problem. But most of the times, 10 trades I'm going to call, like 9 of it must give me profit before it goes to stop loss. That is just waiting for a quality setup. And what am I risking? I'm just risking 12 pips here to gain 70 pips, 10 pips. That is 1:7. My stop loss is never above 20 pips for any reason. If it's above 20 pips, then I'm not going to trade it because I'm not getting my levels very well. Because if you pick any trade right from the 78.6, your stop loss should just be right above that 78.6 level, either at 88.6. That shouldn't be more than 20 pips. So if you're losing 20 pips as against your reward is you're targeting maybe about 80 pips, that is 1:4, which means if you lose that 20 pips, the next trade you're going to take, if you stick to your strategy, remember you have to stick to your strategy, and you also have to maintain your lot sizes. You shouldn't change your lot sizes. Not today you are going to use 0.1. The next day you are using 0.2. The next day you are using 0.01. You won't be consistent, because that is the only way you can win in the Forex market. If you are consistent with your lot sizes. Because believe me, if I had lost this trade today, I would have just lost only $10. Let me just say if I use 0.1, I would have just lost only $10. Only $10. The next trade I'm going to take, probably 1:4. I will be targeting like 40 pips. And if I get that 40 pips, I've recovered from my $10 loss, because I'm always maintaining my lot sizes. I don't change it for any reason. Because the day the loss will come, God forbid, maybe you use one lot size that day, and the market will just come and wipe out all your profits. So remember something. If you have any strategy, maintain your lot size. That is just the secret if you want to succeed. Maintain your lot size. Yeah, we snipers, we are so accurate, but you still have to maintain your lot sizes. Because what if the market goes against you the day you over leverage with one lot size, and the market goes 10 pips against you and takes $100 out of your account? Meanwhile, you've been compounding $100 for, like, let me say, a week. So you understand? So if you want to be taking one lot size, maintain one lot size. I'm not saying you shouldn't over leverage, but if you want to over leverage, make sure that particular lot size is what you'll be using in all your trades. Understand what I'm saying? Okay, so right at this 78.6, this is where the market usually reverses on the smart money level, 78.6. So when you have quality setups like this, what are you waiting for? You set the trigger and you enter the trade. Okay, please recap. What exactly? All right, so you're going. I'm recording the call. The call is so you can just go to my YouTube channel after this session and go to. All right. Yeah, volatile pair. That is volatile pair like GBPs now. Okay. Volatile pair. Should I maintain if you're trading a volatile pair, like for me, like if I'm actually trading GBP pairs, okay, if I'm using 0.1 on every other pair, I will drop it in group. All right. If I'm trading using 0.1 on every other pair, remember, it's not all the pairs. like Euro AUD is not that volatile, but Euro CAD is very volatile. Hope you know that. Like it's quite volatile. If you know the number of pips, like, all right, bro, what pairs do you mostly see smart money? All pairs, they are smart money on all pairs. Smart money on all pairs. So it's just for you to understand and just spot those levels. All right. Okay, so when I'm another question again. Just hold on, can we? All right. So I usually avoid volatile pairs. Like I usually avoid them because most times we have a lot of manipulation. The market just moves anyhow. So if I don't see my trading style, I'll just leave it. Even if it's giving people 100 pips, 200 pips, I'm not going to trade it because one day you just be on the wrong side. So why not just stick to pairs that at least you understand how they move? Pairs like Euro AUD, Euro NZD, Euro USD, and all those pairs, AUD USD, and USD CAD, and all those pairs. So why not just stick to all those pairs instead of trying to chase all those volatile pairs because you want to make all your money in one day? And that's how you're going to blow your money too. Believe me. Because if you like trading the GBP pairs because it gives you a lot of money, believe me, one day GBP pair will take out all your profits, all the profits you've made from all those other small pairs. GBP pair will just come and take everything out. You understand? So this is it. All right. So let me go to USD CAD. I think I have USD CAD, something like this. All right. USD CAD. No, let me go to CAD JPY before I. All right. CAD JPY. Okay, so all right, so I'm going to cover that Fibonacci now, 78.6. Although I've covered a little. Let's check. Okay, all right. So Fibonacci 78.6. Right here. Okay, right here. All right. This markup, I had it like weeks back. I didn't even check this pair. So you see how this might. I had an imbalance here, right here. You see how this market just came here, filled the imbalance and reversed up. Okay. Feel the imbalance, there's an imbalance here, feel the imbalance, went down. So most times we also snipe from imbalance. Then if you want to also check the 78.6 level, right from this drop here, right from here, if you place your Fibonacci from this place here, right here to this down here. All right, so you can see the 78.6 level without even using any candle, like any reference candle. I'm not getting any reference candle here, but just because of the way the market moves. Now the market went up, went down, just like this, creating all these patterns down, something like this. Then, all right, so this is how the market moves. Okay, so once you see the market distributing like this, all you just have to do is just to wait and place your Fibonacci. But remember, you have to know the direction of the market. You don't just place your Fibonacci anyhow. Just hold on, let me explain that again. All right, so placing your Fibonacci right from this move from here to this place here, right here. All right. 78.6. It's not a coincidence. Most people take 68, 61.8. Yes, yeah, most people do that, but you just have to be in a drawdown. Like, yeah, you're going to take a trade here, then you're going to put your stop loss here, right above here. That is how most people trade. Like most professional traders, this is where they put their stop loss. They take it from the 61.8, then they put their stop loss right above here. But as a smart money trader, why should you be in a drawdown when you know when the market will reverse? So just snipe it from the 78.6 level. Most times, this is where the market usually reverse, from the 78.6 level. Oh, yeah, cartel, yeah, that is your 78 points. That's harmonics, yeah. So most times that is a deep retracement. Okay, like today, I don't know if there was someone that actually took a trade on Euro AUD, and he was like, he wanted to snipe from 61.8 level. Yeah, this is 61.8 right here. Look at 61.8 right here. You see, the market actually gave some number of pips right here. You see, the market went down. How many pips did it give? It gave about 19 pips. The market always respects those levels, but it's not going to start moving from there. It might give you some pips, then put you in a drawdown. That's what the market does. So you see, now imagine being in a drawdown of about 40 pips. Most times you might not even hold it. Not even 70%. We have about 90% of retail traders over leverage because you just want to catch the money, you just want to catch the pips. So imagine being in 40 pips drawdown. Can you hold that? Can you hold that trade? You see? Can you hold that trade? Most times you might not even hold that trade. 40 pips drawdown. Like just imagine you used on a $100 account, you use 0.1 and you have 40 pips drawdown, which is minus $40. Your heart is already skipping. So most times you see people closing their trade, or even people that use 0.2, you've been like $80. Your account has finished now. Margin call, they will just close the thing for you. So, all right. So this will be the only pair I'll be analyzing today. All right, Euro AUD. Maybe some other class I will just throw more light on other pairs. But for now, I just want to break down this, concepts, bit by bit. I don't want to, crowd one session with so many markups and, get everybody confused. I hope you understand what I'm trying to say here. Because if I start analyzing all the charts on one Zoom call, you will just get yourself all confused. So can we just take it little by little? After this Zoom call, maybe the next Zoom call, I will take another pair, go into more FIB 78.6 level. Instead of just on one Zoom call, I will try to analyze like 5 charts. I don't know if someone is getting what I'm trying to say here. All right, so is there any question before I end this call? Is there any question? Is there any question before I end this call? Is there any question? This call is actually recorded, so you can actually go to my YouTube channel and any question? This call is about to end in the next 2 minutes. So any question? I think there's no question. So is someone typing? Is someone typing? All right. I think I've got 2 questions. Right. Okay. You said, what is FU? FU is just an institutional candle now. Those are fake outs, kind of. Institutional candle, order block, whatever. They are all the same thing. But that word F and U, I don't know what it means, please. All right. So my YouTube channel, I'm going to post it in the group. Just go back to video on my YouTube channel once I upload it and just go back to this video. You understand it better. Because right now during this session, you might not understand some things I was saying. But when you go back and just take your time and listen to this session again, you're going to understand everything I explained. All right. So during the week, I'll still okay. All right. During the week, I'll still host another Zoom call. All right. Maybe we'll analyze another pair. All right. For now, take care. Goodbye. Yeah, the trade on Euro AUD. Yeah, I've secured my profit though. So if you still want to hold it, they will take back all your profits, no problem. All right. All right, thank you.